The world of investing can feel overwhelming with thousands of ETFs to choose from. But here's the truth. Just 20 ETFs control the majority of all ETF assets in America. These are the giants, the foundational building blocks that millions of investors use every single day. Today, we're explaining every single one of the 20 main US ETFs, what they do, why they matter, and which ones might belong in your portfolio. Understanding these 20 ETFs is like understanding the entire investment landscape because they cover everything you need: US stocks, international stocks, bonds, real estate, gold, growth, value, large cap, small cap. By the end of this video, you'll know exactly what each major ETF does and how professional investors use them to build wealth. Let's dive into the 20 most important ETFs in American investing history. We'll break these down by category so you can see how they fit together. First, we have the S&P 500 giants. Then, we'll cover growth and technology. After that, small and mid-cap exposure. Then, international markets, bonds, real estate, gold, and sector-specific funds. Each one serves a unique purpose in a diversified portfolio. Let's start with the absolute kings of the ETF world. Number one is SPY, and this is where it all began. Launched in January 1993, SPY was the very first ETF ever created in the United States. It tracks the S&P 500 index, giving you exposure to the 500 largest American companies. With over $530 billion in assets, it's the most traded ETF in the world. SPY charges an expense ratio of 0.09%, which means you pay $9 per year for every $10,000 invested. It holds giants like Apple, Microsoft, Amazon, Google, and essentially represents the backbone of the American economy. When people talk about the market being up or down, they're usually referring to the S&P 500 that SPY tracks perfectly. The beauty of SPY is liquidity. It trades with massive volume every single day, making it perfect for active traders and institutional investors who need to move large amounts of money quickly. The bid-ask spreads are incredibly tight. However, for long-term buy and hold investors, there are cheaper alternatives that track the exact same index with lower fees. Number two is IVV, launched by BlackRock in the year 2000. Here's what makes IVV different from SPY. It tracks the exact same S&P 500 index, but charges only 0.03% expense ratio instead of 0.09%. That's 3 times cheaper than SPY for the identical holdings and performance. IVV has approximately $490 billion in assets under management, making it one of the largest ETFs globally. The main difference between SPY and IVV is that IVV is better for long-term investors who prioritize low costs, while SPY is better for traders who need maximum liquidity. Otherwise, they're virtually identical in holdings and returns over time. If you're a buy and hold investor putting money into your retirement account monthly, IVV saves you money compared to SPY. Over 30 years, that 0.06% difference in expense ratio compounds significantly. Both are excellent choices, but IVV wins on cost efficiency for passive investors building wealth slowly over decades. Number 3 is VOO, launched in 2010 by Vanguard, the company famous for pioneering low-cost index investing. VOO also tracks the S&P 500 and charges just 0.03% expense ratio, matching IVV's low cost. With approximately $520 billion in assets, it's equally massive and popular. So we have 3 giants: SPY, IVV, and VOO, all tracking the exact same index with slight differences. SPY is the most liquid for trading. IVV and VOO are the cheapest for long-term holding. Vanguard fans prefer VOO because of the company's unique structure where the fund is owned by its investors, aligning interests perfectly. The takeaway: if you want simple, diversified exposure to America's 500 largest companies, any of these 3 works perfectly. Choose SPY for trading, IVV for BlackRock's ecosystem, or VOO for Vanguard's investor-owned structure. You cannot go wrong with any of them as your core portfolio holding representing US large-cap stocks. Number 4 is QQQ, and this is where things get exciting. QQQ doesn't track the S&P 500. Instead, it tracks the NASDAQ 100 index, which holds the 100 largest non-financial companies listed on the NASDAQ exchange. This means heavy concentration in technology and innovation. QQQ was launched in March 1999, right before the dot-com bubble burst, and it survived that crisis. Today it holds over $280 billion in assets, with an expense ratio of 0.20%. The top holdings include Apple, Microsoft, Amazon, Nvidia, Tesla, Meta, and Google. It's basically a bet on American technology dominance and innovation continuing. QQQ has massively outperformed the S&P 500 over the past decade because technology stocks have dominated. But it's also more volatile. When tech sells off, QQQ drops harder. When tech rallies, QQQ soars higher. It's the growth-focused complement to the more balanced S&P 500 funds. Number 5 is VTI, which stands for Total Stock Market Exposure. While SPY, IVV, and VOO only hold the largest 500 companies, VTI holds approximately 3,700 stocks, representing the entire U.S. stock market, including small and mid-cap companies. It's true total market diversification in one fund. VTI charges just 0.03% expense ratio and holds about $450 billion in assets. The performance is very similar to the S&P 500 because large cap stocks dominate by market weight, but you get that extra exposure to smaller companies. Many investors prefer VTI as their one fund solution for complete U.S. equity exposure. If you had to choose just one U.S. stock ETF for your entire life, VTI would be the most comprehensive choice. You own a piece of virtually every publicly traded company in America. It automatically rebalances as companies grow or shrink. It's the ultimate set-it-and-forget-it investment for U.S. stocks. Number 6 is IWM, the small cap ETF that tracks the Russell 2000 index. While the S&P 500 focuses on large companies, IWM focuses on 2,000 small cap companies. These are smaller, more volatile, but potentially higher growth businesses. IWM has about $60 billion in assets and charges 0.19% expense ratio. Small cap stocks historically outperform large caps over very long periods, but with much higher volatility. IWM gets crushed harder during recessions because small companies are more vulnerable. But during economic expansions, small caps can explode higher. It's a great diversifier if you already own large cap exposure. Professional investors use IWM to tilt their portfolio toward the small cap premium. If you believe smaller companies will outperform going forward, you add IWM alongside your S&P 500 holdings. It's pure small cap exposure without the complexity of picking individual small stocks. Number 7 is EFA, which gives you international developed market exposure. EFA tracks markets in Europe, Australasia, and the Far East, hence the acronym EAFE. It holds companies from Japan, UK, France, Germany, Switzerland, and other developed economies outside North America. EFA has approximately $60 billion in assets and charges 0.33% expense ratio. Top holdings include Nestlé, Samsung, Toyota, ASML, and Novo Nordisk. It's your diversification outside the U.S., protecting you from being 100% concentrated in American markets. Geographic diversification matters for risk management over decades. International stocks have underperformed U.S. stocks for the past 15 years, but that doesn't mean they always will. Markets cycle. Having EFA in your portfolio ensures you participate when international markets have their turn to outperform. It's about balance and not putting all eggs in one country's basket. Number 8 is AGG, the bond ETF that everyone should understand. AGG tracks the U.S. aggregate bond market, holding over 10,000 investment-grade bonds, including government, treasuries, corporate bonds, and mortgage-backed securities. It's the bond market in one fund. AGG charges 0.03% expense ratio and holds about $115 billion in assets. The current yield is around 4.5%, and it pays monthly distributions. When stock markets crash, AGG typically holds steady or even rises as investors flee to safety. It's the stabilizer in a balanced portfolio. The classic 60-40 portfolio uses 60% stocks and 40% bonds. And AGG is the easiest way to get that bond exposure. It's boring, it's safe, it won't make you rich, but it protects your wealth during stock market crashes. Every balanced investor should own bonds, and AGG is the simplest solution. Number 9 is VEA, another international developed markets fund similar to EFA but from Vanguard. VEA also covers Europe, Pacific, and developed Asia, but charges only 0.05% expense ratio compared to EFA's 0.33%. That makes it significantly cheaper for the same exposure. VEA holds approximately $130 billion in assets and is essentially the low-cost alternative to EFA. The holdings are nearly identical, tracking developed international markets. If you want international exposure and prefer Vanguard's rock-bottom fees, VEA is your choice. It's functionally the same as EFA, but saves you money annually. Number 10 is BND, the Vanguard Total Bond Market Fund. BND is similar to AGG, tracking the broad U.S. investment-grade bond market, but charges even less at just 0.03% expense ratio. It holds about $110 billion in assets and provides comprehensive bond exposure. BND and AGG are nearly interchangeable. Both give you total bond market exposure. Both charge ultra-low fees. Both pay monthly income. The choice comes down to preference. Do you prefer BlackRock's iShares, which is AGG, or Vanguard, which is BND? Either works perfectly as your bond allocation. Number 11 is VWO, which stands for Emerging Markets Exposure. While EFA and VEA cover developed international markets, VWO covers emerging markets like China, India, Taiwan, Brazil, and South Africa. These are faster-growing economies, but with higher risk and volatility. VWO charges 0.08% expense ratio and holds about $90 billion in assets. Top holdings include Taiwan Semiconductor, Tencent, Alibaba, and Samsung. Emerging markets are extremely volatile, but offer higher growth potential. Adding VWO gives you exposure to billions of people in developing economies. The case for VWO is simple. Emerging markets represent the majority of global population and economic growth. Yes, they're riskier. Yes, they've underperformed recently. But over 30 to 40 years, you want exposure to where the growth is happening. VWO provides that exposure efficiently. Number 12 is GLD, the gold ETF that everyone knows. GLD holds physical gold bars in secure vaults and tracks the price of gold. When you buy GLD, you're buying exposure to actual gold without having to store bars under your mattress. GLD has about $70 billion in assets and charges 0.40% expense ratio. It doesn't pay dividends because gold doesn't generate income. It's pure price appreciation or depreciation based on gold's value. Investors use GLD as a hedge against inflation, currency devaluation, and financial system instability. Gold historically moves opposite to stocks during crises. When markets crash, gold often rallies as investors seek safety. GLD is the insurance policy in your portfolio. You hope you never need it, but you're glad it's there when everything else is falling apart. 5 to 10% allocation is common. Number 13 is VTV, the value stock ETF from Vanguard. While growth stocks focus on future potential, value stocks are mature, profitable companies trading at reasonable prices. VTV tracks the large cap value index with companies like Berkshire Hathaway, JP Morgan, and Johnson & Johnson. VTV charges 0.04% expense ratio and holds about $125 billion in assets. Value stocks tend to be less volatile than growth stocks and often pay higher dividends. They underperform during bull markets but hold up better during downturns. VTV is the defensive equity play. Investors use VTV to balance out growth-heavy portfolios. If you own a lot of QQQ or tech stocks, adding VTV gives you exposure to stable, dividend-paying value companies. It's the tortoise to growth's hare, slow and steady, less exciting but more consistent. Number 14 is VUG, the growth counterpart to VTV. VUG focuses on large-cap growth stocks, companies expected to grow earnings faster than the market average. Think Microsoft, Apple, Nvidia, Amazon, companies investing heavily in future growth. VUG charges 0.04% expense ratio and holds about $140 billion in assets. Growth stocks are more volatile but offer higher long-term returns, historically. VUG has crushed VTV over the past decade as technology and innovation have dominated. It's the aggressive equity position. If you're young with decades until retirement, VUG's growth focus makes sense. You can handle the volatility for the higher potential returns. If you're older or more conservative, VTV's stability might be better. Many investors own both to balance growth and value exposure. Number 15 is IEFA, another international developed markets fund from BlackRock. IEFA is similar to EFA, but charges only 0.7% expense ratio, making it much cheaper. It's become more popular than EFA specifically because of the lower cost. IEFA holds about $120 billion in assets and tracks developed international markets excluding the US and Canada. It's the cost-effective way to get international diversification from BlackRock's iShares lineup. If you want international exposure and use iShares products, IEFA is superior to EFA due to lower fees. Number 16 is IJH, the mid-cap ETF tracking the S&P Mid-Cap 400 index. Mid-cap stocks are the middle ground between large, stable companies and small, volatile companies. IJH gives you exposure to this sweet spot with 0.05% expense ratio. IJH holds about $80 billion in assets with companies that are established but still have significant growth potential. Mid-caps historically offer strong returns with less volatility than small caps. It's the Goldilocks of market cap exposure. Not too big, not too small. Number 17 is VIG, the dividend appreciation ETF, focusing on companies with a consistent history of increasing dividends. VIG doesn't just look for high yields, it looks for growing yields, which indicates business strength and shareholder-friendly management. VIG charges 0.06% expense ratio and holds about $80 billion in assets. Companies include Visa, MasterCard, Microsoft, companies that raise dividends annually. VIG provides both income and growth, making it perfect for investors seeking reliable cash flow that increases over time. Number 18 is VNQ, the real estate ETF tracking REITs and real estate companies. VNQ gives you exposure to commercial real estate, residential properties, data centers, cell towers, all without buying physical properties. It charges 0.13% expense ratio. VNQ holds about $38 billion in assets and pays attractive dividends from rental income. Real estate provides diversification from stocks and bonds. It moves differently from equities and provides inflation protection. VNQ is the easy way to add real estate to your portfolio without becoming a landlord. Number 19 is XLF, the financial sector ETF, holding banks, insurance companies, and financial services firms. XLF includes JP Morgan, Bank of America, Wells Fargo, Berkshire Hathaway, giving you concentrated exposure to American finance. XLF charges 0.10% expense ratio and holds about $45 billion in assets. Financials perform well when interest rates rise and the economy is strong. If you believe in the financial sector's growth, XLF is the pure play. It's more volatile than diversified funds, but offers targeted exposure. Number 20 is LQD, the investment-grade corporate bond ETF. While AGG and BND hold a mix of government and corporate bonds, LQD focuses specifically on high-quality corporate bonds from companies like Apple, Microsoft, and JP Morgan. LQD charges 0.14% expense ratio and holds about $33 billion in assets. It pays higher yields than government bonds because corporate bonds carry slightly more risk. LQD is for investors who want bond income but are comfortable with corporate credit risk instead of pure government safety. So there you have it, all 20 of the main US ETFs explained. SPY, IVV, and VOO for large cap US stocks, QQQ for technology and growth, VTI for total market, IWM for small caps, EFA, VEA, and IEFA for international developed markets, VWO for emerging markets, AGG and BND for bonds, GLD for gold, VTV for value, VUG for growth, IJH for midcaps, VIG for dividend growth, VNQ for real estate, XLF for financials, LQD for corporate bonds. With just these 20 ETFs, you can build virtually any portfolio strategy imaginable. Want simple? Buy VTI, VA, and BND. Want aggressive? Growth? Buy QQQ and VUG. Want income? Buy VIG, VNQ, and LQD. Want maximum diversification? Combine them all in proportions that match your risk tolerance and goals. The beauty of these 20 ETFs is that they're all low-cost, highly liquid, and battle-tested. They've survived market crashes, bull markets, and everything in between. They represent trillions of dollars in investor capital. Understanding these 20 ETFs means understanding how the smartest investors in the world build wealth systematically over decades.